There's also greater confidence in the trajectory of the organization. I think my dad said it pretty simply, like he just trusted the employees were going better.
So I'm Tabitha Crosscutt with Steiker Green Epelo and Crosscutt. We're an ESOP law firm, 6 attorneys, and I have an office here in Burlington on College Street, and I also work out of our Bedford, New Hampshire office. And with me today I have John Murphy. Go ahead and introduce yourself, John.
John Murphy.
He's really helpful. He's really helpful.
John Murphy with Atlantic Management Company. We're in Portsmouth, New Hampshire. We're an evaluation and ESOP advisory firm.
And Mr. Stiller.
Hi, Dave Stiller with Heritage Aviation.
So just to give you a sense for what we're talking about, there is some order to this, just giving you some general information about ESOPs leading up to the more detailed information. We're going to tell you how the Heritage Aviation ESOP works specifically. That's what we told all the employees so that they can understand how their ESOP works. And then we're going to describe to you, as we described to the employees at Heritage, how they have an opportunity to make a difference in their company utilizing ESOP. So specifically, in the outline of what is an ESOP, we're going to talk about what is the ESOP itself. And remember, this was a presentation originally designed for the employees of Heritage. So we're sort of thinking you guys don't know anything about an ESOP. So if you do, that's great. Why an ESOP and the Heritage ESOP transition? How does the plan itself run? So what are the ESOP rules? What could this ESOP at Heritage be worth? So from a valuation perspective, we're going to give some description of what that means. Who votes the ESOP shares? Because it's always a really interesting question. So the idea of governance in an ESOP company. And then the name of the game, of course, is profits. Whether you're an ESOP company or not, cash is king. So it's all about profitability. So what is an ESOP? An ESOP, hopefully by now, after having been here for a few hours, you know what it is. It's an employee stock ownership plan. And I always say, one thing I ask you to do is not leave here and tell somebody that it's an employee stock option plan. I will hunt you down. It's an employee stock ownership plan. It is a special type of qualified retirement plan. It is funded entirely through company contributions. So an ESOP, typically, there are some, but typically an ESOP does not take employee money to buy stock of a transitioning or departing owner. It's all company generated cash that's utilized. So that is usually a pretty interesting question, because some people actually think that they are going to be able to get the employees to come forward and buy the stock, and they're really not interested. That's the co-op model, so that's the other session. It's a benefit funded in stock and cash. So some ESOPs have all cash for a period of time. Some ESOPs have all stock for a period of time. And then they get a mix going after a while. It really just depends on the ESOP. What are the objectives of the company and the selling shareholders? And what is this ESOP in particular trying to accomplish? It's a benefit that will be paid to employees when they leave or retire, hopefully when they retire. And what we didn't get into the details with the Heritage employees because you don't want to overwhelm them, but hopefully by now you know that ESOPs are governed by the Department of Labor and the Internal Revenue Service. So yes, we have to answer to and be cognizant of our agencies as we design ESOPs and the transactions. ESOPs versus other retirement plans. Obviously, if I'm an employee of an ESOP company, I probably know a lot about 401k plans, right? I've probably got some idea of how those operate. So when we present about ESOPs to employees, we try to bring it back to that place. And actually, when I'm talking to owners, that's what we're talking about, is trying to compare the ESOP and how it's similar or different to a 401k plan. So that's what this slide is designed to do. Similarities between an ESOP and other retirement plans like a profit sharing or a 401k plan is that the company contributes cash to the employee's accounts. As I said before, we're not looking to use employee deferrals. This is company money that's being put into a retirement plan. Employees receive the value of the accounts when they leave, and then the employees don't pay tax until they receive the benefit in the future. So it's tax deferred money, just like a 401k plan. The major differences, however, are the crucial points here. The ESOP uses the cash to buy stock of the company instead of investing in outside public company stocks, mutual funds, whatever it is. So it's a non-diversified benefit account that employees have in the ESOP. ESOP benefits, as I said, are not diversified. And the other really big difference that obviously we want to send home to employees is that they have the ability to affect the value of their retirement fund. So unlike a 401k plan where you put your money into a public company stock and you have no idea what's going to happen, you're just really hoping that it's going to increase. In your company, you actually have the ability to affect the bottom line. And so that translates directly to your retirement funds, hopefully, when you're paid from the ESOP. So we want to make sure that employees are aware that there are other ESOP companies out there. So there, as Cindy said this morning, 7,000 ESOPs in the U.S. That number changes, covering approximately 14 million employee participants, depending on the study you're looking at. But the key for employees is that this is not a loophole in the tax code. There are other big players who are well known in the ESOP community in Vermont that have implemented ESOPs successfully. So you have our friends at Harpoon Brewery who are not 100%. They are 47% ESOP. King Arthur Flour, who everybody knows and loves, who's been 100% ESOP for a really long time. And Gardner's Supply, of course, Cindy told the story of Gardner's this morning. So some pretty significant players. So with that little introduction, I'm going to turn it over to David.
So talk a little bit about kind of what we are and what we do, and flip through a couple more slides about how we looked at whether or not to become an ESOP, and then what it looked like, and then kick it back over really to the experts. Certainly one of the things I learned early on in this process is how important it is to have experts, because it's not quite rocket science, but at least for me, understanding some of how it works at first, I had to read it a few times. And it was really good to have people to count on that, know what they're doing. So with that said, Heritage is a fixed base operator. So it's one of those kind of weird terms, the acronyms in FBO. What we do is fueling, de-icing, aviation support, and maintenance services at Burlington Airport. So we're filling up the gas in all the airlines. We've got a ramp space, which is basically like a parking lot for general aviation coming in, smaller planes, private, corporate travel. And then we maintain those planes as well, either for people who own planes that keep them with us, or for others regionally, basically, if you need to do their annual checks, things like that, they'll fly their planes up and we'll maintain them for them. There's been a number of owners at the fixed base operator at Burlington, going back to the 80s. They've gone by different names. There have been different owners. The current owner bought the business in the mid-2000s. And that actually, in this case, was my family, my dad specifically. And he ran the business, had someone running the business for a number of years. They tried to develop a business unit that was air taxi or air charter service. So actually have planes market and try to look for people that have a need to fly privately, and sell those flights. And unfortunately, they couldn't make that business work here. They tried. There are a number of things that led to it needing to be wound down, but that happened, and there's kind of a regrouping or refocusing on the other core pieces of the business that did make sense and did work here. And that's the fueling, the de-icing, the maintenance, which I mentioned, which we do now exclusively. Around that time, the then president of the company was really running that air charter taxi business and knew that really well. And as part of kind of the restructuring, he moved on and someone else was brought in. At that time, the owner and management started to look at, okay, we're going to be ready for an exit in the next few years. What are the options that are out there? The interim president did have experience with ESOPs, which was a nice plus and kind of brought this to the table. And so, we started kind of looking for this, a few years ahead of doing it. And some of the preparation even began at the company where we started talking about ESOPs. We brought in, I think, Tabitha, and I think someone else as well. This is before my time. to present to employees, what it's all about. And we started doing some open book management even as well. So I mentioned some of the factors about going into why an ESOP versus something else. There was a practical need just from a timing perspective with succession for the current owner. So that was, certainly a factor. He, lives in Florida half the year, isn't really hands-on, had some other things going on, and just, the timing was right for him to be less involved. There were some greater tax considerations as well, practically speaking, that went into looking at, the timing for the exit. In addition to that, though, there was really high value placed on, the concept of an ESOP. You hear about like social value, impact value, and looking at the other potential options. In this particular case, it looked like the strategic buyers would be one of those buyers that would move a lot of the positions, out of the state. There wouldn't be that connection, to the community, and those were pretty big, value pieces in the eyes of the owner. And so, looking at the stewardship which the ESOP provides, actually, really came into play when there was a potential opportunity for a strategic buyer at a higher price, to weigh that against, some of the social or intangible value that you do get with an ESOP. And in this particular case, that value provided by the ESOP was of greater value than the highest bidder. There's also greater confidence in the trajectory of the organization. I think my dad said it pretty simply, like he just trusted the employees would run it better. Than a large corporate player who, again, no ties to the area, doesn't really care. They're, managing quarter by quarter and not looking at some of the same things that the employee owners would be looking at in terms of how to run the business, what the future looks like. So that goes, for management of the business, but extends to the value that the customers receive in terms of customer service, and also, again, mention the ties to the community, both the airport community as well as the region. And of course, too, in some ways it goes without saying, but there's much better, greater benefit and value, I think, to the employees in an ESOP. It's certainly something, I believe in. I'm still learning more and more about it, but the jobs stay local. Cindy mentioned some of the statistics about the lower turnover during the recession in ESOP companies. We look at wages as well, and opportunities for development. These are all kind of things that really matter to us at Heritage, and there's things that we think the ESOP naturally doesn't make happen automatically, but it lends itself to really encouraging and fostering when it's tied to other good management practices. So in structuring the transaction, I wasn't directly involved, and it was a little bit interesting because here I am the son of the seller, but I'm really management of the company. So I had to kind of be clear about which hat I'm wearing, and it was really focused on management, what's in the best interest of the company. So as some of this was getting set up, I look at this slide and kind of say, we've made the transaction, and as soon as we did, we wanted to purchase some shares from the plan because we wanted those to go into employees' accounts. Did I get that all right? Because you get those valuations and those distributions. You get the valuations and statements issued to employees once a year. And when that first statement comes out this year, it hasn't come out yet, we want people to have something in their account. So they can not only see that I have a piece of this company, but more importantly, next year when they have more, and hopefully as the value of the company's gone up as well, they'll be able to start to see that traction or that momentum building, albeit slowly, towards what they own in the company and what it's worth, and make that connection from, we own the company to, wow, here's my piece of paper that shows me, what it's worth, and hopefully with that, build that motivation about I can control or influence at least the value of these shares. Anything else you want to mention?
Yeah, I'll just add for this particular slide, just because it's important for the lead-in for another slide, that first of all, there's a lot of different ways to structure an ESOP transaction. And so the Heritage structure might not be the same structure that another company uses. It's really all about what are we trying to accomplish for the company, for the selling shareholders, for the employees, and then building that transaction structure around those objectives. And so for Heritage, what we were able to do is, because we were looking at an S corporation company that was going 100%, and getting the tax benefits of being 100% ESOP owned S Corp, which does not pay tax because the ESOP is a tax exempt entity, is we did what is a very typical transaction of redeeming the stock from the owner and then having the ESOP buy some remaining shares. So this slide just indicates that the ESOP purchased 6,000 shares for a note, and then that note between the company and the ESOP, we call it an ESOP note, is payable over a 20-year period. And that's going to be important as we get to some of the coming slides.
So here are a couple, steps of kind of what we walk through, and again, I'll ask Tabitha to help out to make sure it's, well articulated. But basically, there was this feasibility analysis done, and I would say even before that, there was this notion of, the time is right for an exit soon. What are the options that are out there? I actually went to a VEOC session on succession and exits, which was here in Burlington, which was pretty nice, and they gave a nice framework. So that was part of my education. The seller was kind of looking at, okay, what are the options? Then there was a feasibility analysis done, so hiring of a third party representing the seller that said, if this is going to work, what's it going to look like? In terms of looking at the numbers, is this feasible to be an ESOP and self-sustain itself and be good on its own, so to speak. That kind of rolled into evaluation of, based on the feasibility study and what that looked like, what would be an appropriate value of this company. And again, this is from the seller side, because the trustee will has their own representation that comes in a little bit later. From there, we designed the plan document. So this is kind of like the rules of the road for the ESOP. Who gets shares and how much, and when are those allocated, when do they vest? And it also covers a number of, I don't know if they're extraordinary circumstances, but it covers kind of like the roadmap. If this happens, what are the rules for who gets shares in the company, how much and when? And it's actually a really important document. I'm not fully doing it justice here. Maybe you can speak more to that.
Yeah, and Heritage really took a good focus on the plan document, having worked with Steve McGowan, who was at one time an ESOP attorney locally. There was a lot of focus around what are the terms of the ESOP plan itself. So how do employees become eligible? What do they have to do to get shares in the ESOP? So we spent a great deal of time, and they actually had a committee, which I think is important to focus on. A committee of people, I think there was 8 at one time we sort of went through. So a committee of people that sat down and really talked about what are the terms of the document, and the rules of the road, which I think is a great way to say it. And so it took some time, and we actually did that at the same time that all of these other things were happening on the transaction side. And I think it turned out really nicely, and everybody sort of had buy-in to that process, which was a really nice way to do it.
Yeah. I'd echo that, and that was a really significant, I think, decision we had, or a good decision. It was, again, before my time, so I'm not taking any credit, but to turn that over to a group of employees voluntarily wanted to participate on that committee and say, okay, here are all the questions that we're faced with this plan document that we have to fill out. Let's have a healthy discussion about what's fair. So one, tangible, grounded example is, well, how much credit do people get for years of service that they've been here? So if someone's been here for 20 years, should their shares vest faster than someone who's been here for 5 years? And you kind of have to draw a line in the sand somewhere. But by having those conversations with the committee, I think we proactively got ahead of what could have been some questions or issues, let's say. Also, I guess in our case, it was really important, I think, in my position, being related to the seller, that I was pretty much hands-off on that. And even when we selected the trustee, it was really delegated to that committee. So we interviewed, that rolls into the next goal. We interviewed a couple of trustees. We had them on site I sat in those meetings, but really looked for the committee to drive the decision there, who they liked more and why. And we ultimately, took that recommendation, hired Horizon group out of the Midwest. And from there, they brought in, this is where in my mind, kind of the negotiation starts. The company has a financial advisor and counsel, and so does the trustee. And so they brought in, John, and they did some of their other diligence to look at how's this going to work, including and culminating with an on-site, due diligence meeting where the management basically presented to the trustee, here's our company, they did the tour and all of that, and then, they went back and did their work with their committees and, their paperwork, their due diligence. That's too when a lot of the transaction documents started to be prepared, and there are a lot. At least from my perspective, it was one. I do a lot of stuff online, and this was one of those hands up. We got to print everything out in a binder or tabs, and go through it because, in my experience, at least it was new for me. There's quite a bit to go through there. A couple things going on in the background. We're introducing open book management to the company. Getting people more comfortable with how the business makes money. We mentioned some of the on-site ESOP education events. We sent people to this conference. We sent people to the national conference as well. Again, to get buy-in, start to educate people about it a little bit.
Up until about 2 years ago, ESOPs were fairly looked upon as a friendly transaction. It would not be uncommon for a firm such as ours that does valuation work and feasibility work meaning transaction structure, to come in and meet with, Dave or Dave's father, and come in and explain what we thought the preliminary value of the business might be, and put together a structure, a couple different structures, and ultimately try to get buy-in on this from the seller's perspective. That's very common. We'd be working with the seller in the company, and once the seller said, yes, this is good, we want to move forward with this, the trustee, as David said, the trustee would be brought in and we would switch allegiances. And then we start working for the trustee who is really the buyer. The Department of Labor basically said, we don't like that structure, and quite frankly, it makes a lot of sense because in the real world, when there's a third-party sale, you don't have an investment bank representing a seller and jumping ship and representing the buyer. So that's why in this particular case, there was a firm that came in, did all the feasibility analysis on behalf, and it's good. I mean, I was talking to somebody yesterday, and they said, we used to hear that ESOPs were friendly transactions, and now they're becoming adversarial. And I corrected them. I said, they're not adversarial, but they do need to be a negotiated transaction. So the days of a firm like ours coming in and say, okay, the value of the transaction is going to be $1 million, and the seller says yes, and the buyer says yes, those days are behind us. And again, in my opinion, rightfully so. So, as Tabitha alluded to, there is a myriad of transaction structures that one can use to ultimately have the ESOP obtain ownership, whether it's 5% or in this case it's 100%. But at the end of the day, the two most common are the ESOP turns around and buys stock directly from the selling shareholders, or, as was done in this case, the company redeems stock from the selling shareholders, and then the ESOP buys stock from the company. Why do you want to do that? Well, first and foremost, there's a lot of different reasons, but the bigger ones is that when the ESOP buys stock directly from the selling shareholder, there's a note that's involved because the ESOP, as we all know, doesn't have any cash or capital to buy, so there's a note involved. One of the things that'll get looked at in the feasibility study is how long do we, as the advisors, want it to take for all the benefits, all the value to sprinkle out to all the employees. If you do a direct loan from the ESOP to the selling shareholder wants to get paid off rather quickly, but it doesn't make a lot of sense to have all that stock allocated to everybody in a very short period of time. Does everybody know, what's a common retirement benefit that most employees receive at a company? What's the magic number?
3%.
3%. So it's very common if you try to have the ESOP purchase stock directly from the selling shareholder and you want to use a 5-year note or 7-year note, that benefit could ultimately be 15, 20, maybe even 25% of pay. A huge, tremendous benefit that it just doesn't make a lot of sense to do it. So that's why one of the reasons. There's a lot of others. I'm not going to bore you with it, but so in this particular case, there was a redemption done, and then the ESOP turned around and bought the stock from the company. After the stock, once the stock is purchased, of course, somebody needs to be paid back. Whether it's the company, whether it's a bank, whether it's the selling shareholder, whatever the case might be. This is where one of the big benefits comes into play. It's the only time that a company can incur debt and have debt on its balance sheet, and it gets paid with after-tax dollars. It's the only time you'll ever see that. Debt, typically, interest is always deductible, but the debt principal portion is always paid with after-tax dollars, except for in this particular situation. So what will happen is the company will make a contribution to the ESOP. Typically, that contribution is an amount that will satisfy both the principal and interest payments. And then, in turn, the ESOP makes those contributions, give those contributions right back to the company to satisfy debt. And if there happens to be an outside bank involved, then that money turns around and goes to the bank. It has to follow that crazy route just to create that tax deduction. But like I said, we could have a USA Today chart for, charts and charts showing you all the different ways that it can happen. So if we go to the next slide, Dave alluded to the ESOP document. That's really the Bible of an ESOP. And these are it's yay thick. And there's an abbreviated version called the Summary Plan Description, SPD, that kind of just hits on the big topics. And typically that document will be given to all the employees. The actual ESOP agreement oftentimes isn't, just the abbreviated version is. And so these are really the big topics of conversation. And when you look at the first ones, how do the participants, the employees, how do they get into the ESOP? How do they get, what amount of the value that's in the ESOP gets allocated to them? Vesting is, okay, whatever balance is sitting in my account, how much of that can I get today if I were to leave versus how much do I get a year from now or 2 years ago? Distributions, when am I going to get paid out and how do I get paid out? Diversification, I've been in the plan a long time. I'd like to have the same rights that the selling shareholder has. I mean, an individual that's owned stock that's been deciding to do an ESOP, one of the things they're doing is they're taking some of the eggs out of that basket and diversifying it. Well, we don't want, for some of the older timers in here, like myself, we don't want another Enron situation where all the retirement benefits just vanish overnight. And so there's opportunities for the participants to diversify after they've been in a plan, and some slides that talk to all these points. And voting, and then lastly is valuation. So in each and every one of these, I'm going to talk about one of them, and then Tabitha's going to take the slides and the rest of them. So the first one's eligibility. I would say, if the one word I can always say here is, while an ESOP falls under ERISA and has regulation and guidance from the Department of Labor and IRS, Internal Revenue Service, it's an extremely flexible plan. There is not a one-size-fits-all scenario. And so oftentimes the ESOP attorney will come down and come meet with the management team, the committee, the owners, whoever's making the decisions, the board, as to what this plan is going to look like. And the first part of it is, what's the eligibility? When are people going to get, how do they get into this plan? It's common that you're going to use a year of service with a company. It's common that you're going to say, in order to be eligible, you have to work at least 1,000 hours. It can be more, it can be less. As I said, it's not a one-size-fits-all. And it oftentimes depends upon what your company is like. So I'll give you an example. It's not uncommon for certain situations to say, you have to have 1,000 hours of service, and oh, by the way, you need to be employed on the last day of the year. If you're a company that's not seasonal, there's very little cyclicality, that's maybe not such a bad, it's not a bad thing. However, if you've got a business that's fairly cyclical, and the winter time is a slow period of time, if you have that kind of provision in your plan, you're going to have a lot of individuals that aren't going to be eligible to be in the plan because they may have had the 1,000 hours of service, but they're not going to be there on the last day of the year. So it's all of these elements that you start to look at. And we just put an example of as to when if somebody joins the company, when are they actually eligible to participate? It's no different than a 401k plan. The rules are essentially the same.
How is the benefit divided? So this goes back to the conversation we were having about the number of shares that are purchased and how long that internal ESOP note is for. And so in this particular situation, it was 20 years. If you take the allocations in the ESOP, the first thing, if I'm a participant, I want to know is, well, how do I know how much I'm going to get in a given year? So at Heritage, again, using the slides that we presented to their employees, it's basically what we call a safe harbor, is based on relative compensation. So it's my individual compensation as compared to all of the participants of the plan. I'm getting that percentage of the allocation of the shares in a given year. So this is my really baby example. So I understand that no company is going to have 3 employees, but just let's imagine that Heritage has 3 employees and their compensation adds up to $110,000. Those are the percentages that they're going to receive of stock in the very first year that the stock is allocated in this plan. So the 6,000 shares over 20 years. So if I'm employee 1, I'm making $25,000 this year, I will probably get 68.18 shares in the first year out of the total 6,000 shares. That is shares that go into my account in the ESOP. And that would happen every year if everything stayed the same for 20 years. That's a pretty standard way of allocating shares. So the ESOP puts the shares in my account as that ESOP loan is paid for. So they're subject to pledge, their security, right, for the ESOP repaying that loan, just like if you mortgaged your house, right? As you pay it down, your house is no longer as much security for that loan. Same thing is happening here. So as the ESOP pays for the shares, they're released and the employees are getting them. If the employee leaves the company, they're going to get the shares that are in their account over the many years that they're being allocated based on vesting. What is their vested percentage? We're going to talk about that in a minute. So then new participants that come into the plan, they will be allocated shares based on their compensation. And so as new people come and then people leave, it just depends on what is my compensation in a given year as compared to everybody else. At Heritage, and a very standard requirement at most ESOP companies, in order for me to get those shares, it's not just that I'm living and breathing, right? I have to do something every year to be eligible to get those shares. I might be in the plan, I might be 21, have 1,000 hours, and be eligible to be in the plan, but that doesn't mean I'm getting anything, right? So the requirements at Heritage to actually get something is you have to have worked 1,000 hours in that particular year. And you also have to be employed on the last day of the plan year. So most companies are calendar year end. So as long as I'm employed on 12/31 of that year and I work 1,000 hours, I will get my whatever number of shares, 68 shares of stock in that year allocated to my account. Now, there is an exception if I die, become disabled, or I retire in a given year, then I don't have to work those 1,000 hours and I don't have to be employed at the end of the year. Because we're giving those people the benefit of the doubt, and we also don't want to keep people employed when they don't want to be and they're just hanging out so they can get an allocation. Those are rules that are dictated by the plan document for an ESOP, and so that could be different in any company. So when does the participant actually own the benefit? So I have shares in my account. When are they actually mine if I leave? And there are 2 different vesting schedules, and then you can make up a modified schedule if you wanted to, that one or the other. But at Heritage, we have a 6-year rated vesting schedule. So after 2 years of employment, I get 20% of the account in my name if I leave the company. And every year thereafter, it's 20% more. Once I'm vested, you can't take it away from me, and it's not a rolling kind of thing. I get 20% more every year until year 6 when I'm 100% vested. And at that point, everything that goes into my account, I'm 100% vested in. If I leave after year 6, I take my entire account value with me. Accounts of employees that die, become disabled, or retire will become fully vested in this plan. So there are events that would accelerate that vesting. And David was mentioning earlier that one of the really major considerations for most companies is, what about my long-term employees? Should they get additional vesting because they've been here so long prior to the plan's adoption? And so it was a very intense conversation, and usually is, to determine, should we give people this pre-service credit prior to the ESOP? Should we not? How much? And so at Heritage, they did grant 1 year service for every 5 years prior to the plan's adoption, and then only up to a maximum of 2, because we also don't want 100% vest people right out of the gate. That's not a good situation to be in. So there's sort of a modified schedule of giving people credit for being employed prior to the plan's adoption. So this is just a pictorial of the vesting at the 6-year graded. So when do I get my money? If I'm a participant in the plan, this is usually the very first question that they want to know. We wait a little while, but usually it's, okay, great, I've got stock, I've got vesting, but when do I actually get it? And unfortunately, you can't say tomorrow. It's a long-term game here. We're looking for long-term growth in our stock value that you're going to get when you retire. So there are rules that are pretty much, in most companies, it's the same. And as ESOPs age, companies get very comfortable with knowing what the cash flows are and what they're going to need to pay out of the plan as people terminate or retire. And then those, what we call distribution rules, get modified to maybe bring them, make them a little earlier than this. But if you have an employee that leaves employment due to retirement, death, or disability, they're going to start to get payments the year after that termination event, and then they're paid out generally over a 5-year period. Some companies will accelerate that, and they'll pay lump sum maybe in the year after the termination. If you're not retiring, dying, or becoming disabled and terminating as a result, we call it the other terminations, then we can actually wait to pay you out up to 6 years. And so I personally start all our plans at that point because we want to maintain cash flow in the company. So if somebody gets fired or they just quit to go work for our competitor, they're going to wait 6 years before they get their first check for the value of their stock in the ESOP account. And then they will likely be on a 5-year payout schedule. And so they're not going to see the entire account value until up to 11 years after termination. There are different variations on this, but most companies at the beginning will leave the company's stock in the accounts of a terminated employee, so they're actually going to get any growth or downturn in the stock value reflected in their accounts. Some companies will do what we call segregating, and they'll convert that stock to cash once they know that they have sufficient cash flow to support that type of a conversion. So this is, I think, John was talking about diversification. That is really just taking a piece of what I have in the ESOP and allowing me, and there are rules, this is a requirement under the Internal Revenue Code. At a certain point, when I'm age 55 and I have 10 years of participation in the plan, you have to give me the option. It's not forced, but you have to give me the option as a participant to convert, take it, move it to the 401k plan, but do something to diversify 25% of my account. And that goes up to 50% in year 6. There's a total of 6 years during which this can happen. It's completely an option. It's not a requirement that the employee or participant elect this, but it is a requirement that the company offer that in the ESOP. So Heritage won't have to worry about that for a while, which is good.
So in the case of Heritage, it's a private business, it's a private company, and as a result, the value is not determined by the market. It's not determined, you can't go online and see what the value of the company is. So there needs to be evaluation performed by a firm like ours every single year. There has to be evaluation done as of the date of the transaction, and then annually thereafter. And the reason why the valuation is done annually is because, as David said earlier, all the participants are going to get a statement every year. And the only way they can get a statement is there has to be a value determined. And as I said, you can't look online, look in the Wall Street Journal and the internet, etc. So a firm like ours will come in and do the valuation. It's important to note, as I said earlier, the valuation firm works for the trustee. We don't work for the company, we don't work for the sellers, we don't work for the employees. Because the trustee, in this case it's Horizon, is actually the entity of the fiduciary that's charged with setting value. They will work with an independent appraisal firm to help them go through that valuation and come up with a value they're comfortable with. But ultimately, setting the value is the responsibility of the trustee. And what is it that we're actually valuing? We try to use a very simplistic picture to help people understand, whether it's a car, whether it's a home. There's two definitions of value, enterprise value and equity value. And enterprise value is the total value of the asset. So it's the total value of the car, the total value of the house, or the total value of Heritage. When we are determining equity value, which is ultimately the value that gets used and incorporated into all the employee statements, it's essentially the total value less whatever the debt is. So whether it's a car, what you have on a car loan, whether it's what's outstanding on a mortgage, or in the case of Heritage, whatever's outstanding on the transaction-related debt. Equity value is the value that gets used by the third-party administration firm to prepare the statements, and that's ultimately the value that gets allocated and shared by all the participants. As I alluded to earlier, the valuation must satisfy, aside from just all the different associations and standards that we have as appraisers, and there's basically three associations that we follow the most. The evaluation must satisfy the Department of Labor and the Internal Revenue Service. The standard of value we use is always fair market value. And in layman's terms, fair market value is what a willing buyer would pay a willing seller with neither party under any compulsion to do a transaction and both parties having knowledge of all the facts. That's fair market value. I want to come in and I want to go to Heritage and I'd like to own the company. I'm going to come with a checkbook and a bank loan, and that's all I'm bringing. When, as David alluded earlier, when there's companies that are actually going out and buying companies, a lot of times it's going to be what's called investment value or strategic value or synergistic value, where the old 1 + 1 = 3, meaning I'm going to take company A, go out and buy company B. Maybe I can move all the operations into one entity and consolidate the real estate. We only need one president, one CFO, one HR person. So there's going to be savings. The ESOP doesn't bring that to the table when it ultimately buys a stock. So it has to be fair market value. And as I alluded to earlier, the valuation is done every single year. So in this particular case, this was a transaction that was done right before the end of the year. And as Dave said, they want all the employees and participants to receive statements. So what we do is that, although we did a valuation before year end for the transaction, we need to actually get the accountant prepared financial statements that show the debt on the balance sheet. And in this case, that's really the only real major change, because operationally it was very little change, hopefully, in that last couple of weeks before the transaction was done in year end. So we'll actually get that information, and right now we're still waiting on the financial statements. And that gets done, and like I said, that valuation is going to get done every year. It's important to note, and it's important from a communication standpoint to the employees, to help them understand that in the early years, while the debt is being paid off, the growth in value of the company can actually be fairly significant, because it's going to be related to two elements. It's going to be related to any growth of the business just because of operations, and it's going to be related, because again, remember we're talking about equity value, it's also going to be related to the pay down of debt. So if the company pays down 20% of its debt and it grows by 5% in overall value, it's a fairly significant increase in value year over year. And so it's important, as that debt is nearing its maturity and getting paid off, for the employees to realize that, okay, when the debt's finally paid off, unless the company grows significantly, the growth in their value is going to slow considerably after the debt's paid off. And so that's where the communication comes into play. And like we always like to say, it's not a process. It's not an event that just takes place. It's a process that happens over time. When we talk about, for the employees, nobody knows what the future of the stock's going to be going forward. We'd like to think it's going to grow, but we all know that all businesses have cycles of some sort. Generally, not always, but generally, increasing profits typically mean increasing value, and vice versa. As cash flows decline, value is going to decline. There have been companies, I was meeting with somebody yesterday, said, can you give me some examples where ESOP companies have failed? And the majority of the situations that we've been involved in, and fortunately it's only been a couple, where the companies have failed, it's not because of the ESOP, it's because of the industry, pretty much. And it's because of the economy. A couple of companies right after 2007 and 8 really had tough times. Another industry, we had a couple clients in the printing industry, and we all know with everything going to digital, that industry suffered significantly. In this particular case, what I would say is that one of the biggest issues that we see where ESOP companies struggle a little bit is if they do a 100% transaction and the term of that debt repayment is too short, and it really hamstrings the company. So it's the recipe for disaster. You never want to do that. As we talked about, stock value is all based upon profits and cash flow, and value is always looking forward. It's all about risks. When we're meeting with employees of companies, when we do valuation presentations, one of the things we try to encourage them to do is focus on the elements and the issues within the company that they can actually control. They can't control what's going on in the economy. They can't control Wall Street. They can't control the market. They can't control what a competitor does. You know, if you're in the construction trades and you are going up against firms at that point in time that are basically willing to do work for no profit just to keep their staff employed, you can't control that. You can decide whether or not you want to compete with it, but you can't control what they're doing. You can't control what Uncle Sam's doing, what Washington's doing in regulations. What you can control, however, is how you're working with the employees, how the employees are working with their customers and clients, whether they're being reactive to situations, whether they're being proactive to situations. Those are the issues that they can control. Another slide I have sometimes is a slide that shows somebody driving a car with a mirror. Don't keep looking behind. Don't keep looking in the rearview mirror. What's going on? It doesn't help you. Because value, again, is all about looking forward. So that's really about the biggest issues that when we do employee meetings, we try to encourage them, focus on what you can control. There are no guarantees, as we say. The ESOP owns the stock in the company. As we talked about, they fail. Businesses fail. ESOP companies fail. It's not the Shangri-La. It's not a guarantee. It's not absolutely going to ensure that the business is going to continue. Sometimes they're going to fail. More times than not, it's not the ESOP itself. It can be due to what's called repurchase obligations, as Stavin said earlier. You know, as people start to leave, if there's no planning involved for that, and there's ways to plan for it, that can come up and catch somebody. I guess the other last point I'd just like to make sure that we say is that we reference shares. We keep saying shares. The employees get X number of shares in the account. The rest is you. And shares. It's important to note that the employees don't actually have shares. They're not actually shareholders. The ESOP is the shareholder. The employees are really beneficiaries in trust. And so when we talk about it, we try to sometimes think about it as units or something, because what you don't want to do is have, okay, John, you've got 68 shares, Tabitha, you got 23 shares. There'll always be somebody in the crowd, usually probably somebody like myself, that says, okay, now, do I get to fire somebody now? Am I a shareholder? Do I get to see the financials? Do I get that? In the case of Heritage, they're practicing open book management. That's wonderful. You know, the more participatory you have, the studies show that the better and the more successful that the ESOP company is. But it's important to note the employees aren't actually legally shareholders. And on the flip side, that means that they don't have any of those fiduciary or legal obligations of being a shareholder.
So actually, David, I think you experienced that at Heritage. Flip the switch, you're now employee owners. What was your experience with that, with the employees saying, okay, so now we can vote you off the island, right?
Yeah, well, it was interesting because we did build up, you're an owner, you're an owner, you're an owner, as part of this education rolling up to it. Is when I'm an owner, don't I get to vote for my boss?
Right.
Or, and so there was, some education. But by and large, I found that with that education, as people understand it, they're, they don't really resent the situation. I love actually how you put it once, Tabitha, in one of your documents I was reading recently. You said the ESOP was created so employees could become owners without having to invest their own money. And I think that's a really nice way to frame, the discussion when it comes up. Well, I'm not really an owner. It's this is a benefit. So that
right. Sense. Yeah, so that whole concept is captured here because one of the really important points of ESOP that I think in the previous session folks were asking about is, well, what happens with the governance of the company once you're an ESOP? And one of the comparisons clearly between a co-op and a ESOP is this whole concept of, are we real owners? I mean, do we have our names on a stock certificate? And it's a great point, John, that the employees are beneficial owners of the stock. They're not actually named on a stock certificate. Whereas in a co-op, it's completely different. People actually hold shares in that company in a co-op. So it's really essential to just get your head wrapped around that, because as a result, what happens is the day before and the day after the ESOP is implemented, even in a 100% ESOP scenario, it's the same, right? The day before, the day after, nothing changed other than the employee saying, well, wait a minute, can I vote you off the island, right? So, but in reality, they're investors. They have a benefit in a plan based on the value of the stock. They're not able to vote anyone off the island or change their own compensation. There is one set of events that happen in some companies' lives where we do actually have to we call pass-through a vote to the participants of the plan based on the shares in their accounts, and they get to vote. These are the really big events in companies' lives, so merger, recap, sale substantial all the assets, liquidation, dissolution, really big events that might happen. We do have an obligation to participants to direct the trustee of the plan how to vote their shares. And I think we actually put this slide in here for the purpose of really drilling home to the Heritage employees like this, because they had a lot of questions. This is the scenario, so I think it worked.
And I might just add to that,
yeah,
too, if I can. So we try to really make it really clear that because we're an ESOP, you don't automatically, you don't really have rights to vote except in these certain circumstances. But the flip side of that, and I think a lot of ESOPs do, although, you don't have to by virtue of being an ESOP. We try to drive a really participatory culture with open book management. So we try to provide people the feedback mechanisms they need to see how their actions affect the business and a pathway for their ideas for the business so they can see those getting a fair shake and being evaluated when the company's looking at how to invest. And so, we say, on the one hand, no, let's be clear, you're a beneficiary owner, you can't vote for your boss. On the other hand, here's a pathway, for that energy and that passion to have control and influence, the future of the business. And in our case, we use open book management and other processes to get people involved.
Just so you know what participants receive, because another really popular question is, do I have to share all of the financial information with the employees now that we're an ESOP company? And the short answer is no. The ESOP is a benefit plan, and so there is a short list of information and documents that you are required by law to share, but we hope that maybe you'll be an open book type company. Maybe not completely open book, but we have people companies along the entire spectrum. You are required, as a result of adopting an ESOP, to share the summary plan description, which John talked about earlier, which is a summary of the big plan document establishing the rules for the ESOP. A statement of benefits annually, that obviously we want people to know what they have in the ESOP, what's been allocated to them, and what is the value of it. So this is the statement of benefits. And then the summary annual report, which is really, the ESOP has to file a 5500 as its tax return, and the summary annual report sort of boils down that information to what should be a readable one-page document for the employees, which usually goes into the circular file every year, but it is required to be distributed to the employees. And then I always mention the beneficiary designation forms, because the number of questions that arise when you have an unfortunate death in the company and no beneficiary designation form is just really, it's a bad situation. So I always have to mention that. So with that, we promised we would save questions for the end. We welcome questions. Anybody has anything for David, John, or myself?
Question about valuation. Is it like we use wide white as a valuation method? Is that similar to the type of mechanism you guys use when valuing?
Yeah, so the typical valuation approaches are looking at a company's assets and liabilities, which oftentimes isn't used in an ESOP situation. You can look at the market approach, you can look at the income approach. Income approach being looking at the company's historical performance or its future performance, all based on cash flows. And a market approach looking at transactions that have taken place within an industry or public companies that are similar to a company. In your case, Wide White, they've got a myriad of different multiples that they can utilize under their 5 variables, and they've got different versions of that. It's absolutely like when we do evaluation and we're doing evaluations in the AEC space, we'll incorporate that as one of the methods that we do. We will use an income approach and/or a market approach as well, because we always think about when we're doing valuations that somebody is going to review it and challenge it, whether it's the Department of Labor, the IRS, or what have you. those methods are the methods that are accepted in the courts. The Zweig-White, while it's very good data, it's not necessarily a method that's accepted in the court. So we absolutely use it, and it's one that we'll incorporate into our analysis, but we would absolutely also use an income approach or market approach as well.
Okay, how does that compare, if you don't want to continue? No. How does Zweig-White compare with normal? I mean, is it usually higher or lower? I'm just trying to get a sense.
No, it's actually because the data's good. So it's actually it's very comparable to what I would call the income approach when we're looking at the company's cash flows, because most of that data is private company transactions. Most of that data is private company transactions. Where we see the most volatility is in the market approach. When we look at public companies, as you know, I mean, in your space, I mean, the public companies are very large, and those multiples can really change. They can be very volatile, and the multiples can go up, even though oftentimes you see multiples in the market approach for the public companies go up because the earnings and cash flows of a company have gone down. The market as a whole is still pricing these companies here, even though their performance has suffered. So the implied valuation multiple actually goes up. That's when you're starting to see a little bit of a skew. But usually the Zweig-White data is very comparable to what we call the income approach. Yeah.
Thank you.
Can you just touch on some of the pros and cons of being a C Corp versus an S Corp? When implementing
Pros and cons. So it depends on what you're looking to accomplish. I think in the initial session, which nobody attended, I don't think in here, in the C corporation, there is an opportunity to defer the capital gains treatment on a sale by the selling shareholders that gets the ESOP to at least 30% ownership, and then anything above 30%. So that selling shareholder could literally not pay tax potentially forever if they do the various jumping through hoops to reinvest the proceeds. So that's a really big consideration for the C Corps out there. And we do have some companies that have revoked their S elections to be a C corporation to do that transaction. So that's certainly an advantage. Our S Corps, mostly the advantage there is above and beyond the C Corp, which is just the avoidance, I guess is the way to say it, of tax for the portion that the ESOP owns of the company. So you could be a 20% ESOP owned company or 100%. The portion of the stock owned by the ESOP is going to be the percentage of the company that's not being taxed, basically. So the 100% scenario is fantastic because now we can take the tax dollars that would have been sent to Treasury and we're going to keep that in the company and be able to utilize that. So those are the big ones.
Yeah, I'd say if you're an S Corp, which a lot of companies are, really the only two reasons to ever really think about converting back to a C is for the one that Tabitha just said. You want to be able to, you mean the shareholder wants to seriously look at deferring capital gains tax. The other is if the shareholders are not looking to do a 100% transaction. They want to do a minority. They want to kind of step their toes into the water. From a valuation perspective, if the ESOP is going to own something less than 50%, we're going to apply what's called a minority interest discount. And, in today's world, that's roughly 10 to 12% or so of value. So if a business owner doesn't want to have that come off their sale proceeds, what can happen is that, but I'm not going to get into the weeds on it, but the company can be recapitalized and the stock that gets sold to the ESOP can be a preferred stock that has dividend rights. And essentially at the end of the day, the seller is going to sell their 30% or 40% for the full pro rata value. But the ESOP's not going to overpay for it.